Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'll be filling in for Stuart again today, and we've still got a lot of really great listener questions to work our way through, so I'm going to jump in and do a few of them today. First question comes from Sam. Sam has a 17-year-old and a 15-year-old children. He mentions they've been fortunate enough to inherit $50,000 and it needs to be held in trust until they reach the age of 25, and he's acting as the trustee. So his question is about investment options, so ETFs or pool their funds in for an investment property deposit. Sam mentions that he's geared into property and he can subsidise a property purchase because obviously the $50,000 is not going to go all the way, and he could provide good guidance on that because he does have some experience in property. He mentions that the kids are, they're interested in both options. They have no real preference. And then if it is going down the shares route, any advice welcome on ETFs, preferred ETFs, and that sort of thing. So Sam, considering the property purchase option, it's a bit of an interesting one. It's not typically what is done with funds that are held on trust for children because it creates a bit of complexity and there could be some complications with it. It is much cleaner if it's just invested, the $50,000 is invested for them or held in whatever type of investment that's just a liquid investment option like a share portfolio, ETF portfolio of the like, as you've mentioned. That's a lot cleaner because then when your oldest child turns 25, they can clearly take their part, the other one can take their part, it can be transferred over to their name, a lot cleaner, and it's not tied up with you. What the funds in trust are just purely the inherited funds, so then they can just be given straight to the children. If you go into property, it is possible. There's a few sort of implications though. So I guess, if you're going to then contribute towards it, so if you're going to put cash towards it, use their $50,000 as a deposit or whatever, even if that's not the full deposit, if you're going to go and then contribute, say, hundreds of thousands of dollars to then go towards of your own money or borrowed funds, then there's some sort of complications with it. I mean, you've got to think about the way in which it's done. So it could be that you just outright gift it to the trust, so to the children, so it forms part of their inheritance. So that is cleaner because it is just an outright gift. It goes towards it, and then when it comes time for your children to receive that, they just receive the full amount. The other way could be, if you want those funds back that you've contributed, you can set up a loan arrangement. So it's basically like a loan to the trust that's being held for the children. The other way of doing it is co-ownership. You could do tenants in common arrangement whereby whatever say the 50,000 makes up, 10% of the property that you buy, then, your portion would be 90%. So it'd be a 90-10 split in tenants in common arrangement. So there's a few different ways you can structure it there. But, the problem here is that there's still going to be stamp duty. That's still a transfer of beneficial ownership. So the property would be in your name, acting as the trustee, and, you don't get a waiver from stamp duty there. So you would take stamp duty on the way through when it eventually transfers to the kids. The other issue then is, well, a property is a lumpy asset. So how does that get distributed? So then, you could go evenly. You could give it to both of the kids then. So, they could be joint ownership, so 50-50, but they might have different needs or different wants. At the time they might not want half of a property with their sibling. They might want money. They might want it liquid in cash. So you've then got the arrangement that it's got to go to both of them. And then there's also a bit of a timing issue. So there's 2 years age difference between your kids. So how does that work then? And if you need to wait, if the rule is as per the trustee, you need to wait until they're 25, or then you'd probably have to wait until the youngest is 25. So then the older one, there's a couple of years where they're not really getting access to it. So because obviously you can't quite transfer half of the property, you wouldn't do that. So there's sort of those little issues with it. So look, there's complications, Sam, but it can be done effectively. Yes, is the answer. That is a possibility in doing, going into property and you contributing funds towards it. But, there's a lot more complication with it. It needs to be really well documented. There needs to be a declaration of the gift, or if there needs to be a formal loan agreement if there is that. That needs to be, the ownership structure needs to be really spot on if it's then going to be a tenants in common arrangement. So I think you've also just got to think then longer term, maybe have a conversation with the kids about, is this what they really want? Are they going to want to wait until 25 to then get half of a property? So yeah, it creates more, and often, maybe asking a 15-year-old that, they're not going to know the answer to that, I wouldn't think, at this point in time. So, the answer that you get mightn't be that clear, and, their priorities change over time. So it kind of does pigeonhole you a little bit, pin you into a corner. I would think that, really the cleaner, flexible, more broad-based and simple option is just to invest the money for them. And then it's going to give them full flexibility in what they each individually want to do with it when it comes time for them to inherit their funds. So I'd be leaning towards, and what we see most commonly is just investing the funds in the share market. So in terms of what you would invest in, yeah, I think you've mentioned there, you touched on, a Vanguard option. So I mean, without, going through constructing a full portfolio for you, and with 50 grand, I'd keep it really simple. I'd just pick an ETF that's a nice diversified portfolio. So it's kind of like a growth or high growth or all growth diversified option that's taking, it still takes a low cost passive indexing approach. So as you've mentioned there, Vanguard offer a range of diversified. So if you just Google Vanguard diversified balanced growth, high growth investment options, there'll be an ETF for each of those that you could easily invest in through a share trading account that you set up. Beta Shares also offer similar things as another option. They have their balanced growth, high growth, and also all growth diversified investment options, which you can access through an ETF. So I'd be thinking some of those, keeping it really simple. Just think about time frame. It's a fair time frame, even for your oldest. That's, they're 17 now, so quite some time there to be invested. So I think going, growth, a high growth or all growth approach would be reasonable, but this depends on your personal risk tolerance and their personal risk tolerance, of course. So that's what I'd be thinking, Sam. I'd go down that route. The next question is from Daniel. Daniel says, we're a couple. We live in Adelaide. He earns about 105,000, some voluntary super contributions, salary sacrificing on top of that. And the wife earns about 70,000 per annum. No dependents. He is 48 years old and his wife is 51. They own their home, which is worth about 1.1 mil. There's a loan facility there of about 280,000, so not too much left there. But in fact, he says 200,000 of that's in redraw. So in effect, really the owing on the home, the net loan there is only about 80,000, and he mentions that we'll probably have that paid off in the next couple of years. So that's pretty close to paid off there. Look, he mentions that they previously had 2 investment properties, which they then sold in late 2019. He makes some comments about how that wasn't great timing, and in hindsight, that wasn't the best choice there. But in any case, moving forward, he's trying to figure out the best approach as they move towards retirement. The options Daniel's considering is, firstly, pay down the house, then max out super contributions, plus do a little bit of investing in shares outside of super, or look at an investment property, potentially Melbourne, for near-term growth and contribute what extra that we can to super. And there's also sort of a third option about use money in redraw to invest in an ETF portfolio, effectively debt recycling. So extend the home loan repayment time. So it's effectively using some of that redraw, some of that available facility there to invest in shares. So Daniel, I would think, just looking at your age, I mean, we're 48 and 51, sort of in a time frame of retirement in the next 10 years is what you've mentioned. And then based off your income, we've got sort of combined income of 175,000, roughly, call it, with the salary sacrificing. So about combined income of 175,000. I don't think in that time frame with your borrowing capacity that an investment property would be the way to go. I mean, I haven't crunched the numbers on this, obviously, but I just that's my initial thought. And just from looking at a number of these situations for clients, I just don't think that you'd have the borrowing capacity to get a investment grade asset, I wouldn't think. And also, if it's within a 10-year time frame, I wouldn't be confident that you'd be getting that property, paying down enough debt to get it to cash flow neutral in that sort of time frame. So I feel as though the best arrangement for you would be knock off the rest of the mortgage and pump money into super. But in saying that, when I say pump money into super, just maximizing concessional contributions. Maybe in the last couple of years before retirement, you can think about non-concessionals, but really the important one is getting the deductible concessional super contributions. So make sure you're maximizing those. And then if there are any funds left over afterwards with your surplus cash flow, I think building up a bit of personal investment outside of super. Now, in doing that, I think you could do a bit of gearing. You could utilize some of that borrowing capacity. So you might not have borrowing capacity to go and buy, 1.5, 2 mil of debt kind of thing with an investment property, but you would have borrowing capacity there because you've pretty much paid off the mortgage and you don't have any other debt. So, I mean, Stuart's not massive on this, borrowing to invest in shares, but how it would work is you wouldn't use the redraw facility because then redrawing upon that, it might create issues of loan purpose. So really, the cleanest way is to create a new loan. So rather than you clear the redraw and then you just draw from the equity in your home to generate a new investment loan. So it's a completely new investment loan. So I'd be really clean and just have it separated from the home loan. Then it's just a new investment loan. You'd have borrowing capacity to access perhaps, $700,000-$800,000 investment loan, total debt overall. But I don't think you should use all of that. Sure, I don't think you should. But I think, borrowing, maybe a couple $100,000, it just sort of kickstarts that share portfolio. And then I think the aim of the game then would be you then contribute surplus cash flow, your ongoing savings towards that share portfolio, as well as maximizing concessional super contributions. returns. You could do that, but then I think I'd pivot at a certain point. Maybe it's in the years leading up to retirement. I don't know what your super balances are. You haven't mentioned that. So maybe it's a case that I think when you're getting close to retirement, you should start looking at doing non-concessional contributions to super just to maximize it because it's all going to be tax-free in there anyway. I mean, with the share portfolio, if you're doing gearing with a share portfolio, outside of super naturally in your personal name, you can't. I wouldn't let it just run by itself. So at the point of retirement, you don't want it to be running at a negative cash flow, and generally you want to then have the debt at about 50% of the share portfolio as a general rule of thumb. That should ensure that there's no losses from it. It's kind of running at about cash flow neutral, and it's sort of washing its face. So it's the same idea as with property, really, as it is with shares when there's gearing in it, I think. So that could be something to consider. Maybe a little bit of gearing, maybe a couple 100,000 or 200,000 maybe, just to sort of kickstart an ETF portfolio in your personal name, get some negative gearing there. But then I'd be really focusing on, the home will pay itself off, pumping money into super, depends how much you've got in super. But I just don't feel like the investment property would be the way to go with that time frame and borrowing capacity for you. I hope that helps, Daniel. Okay, so the next question is from Brenton. Brenton gives a bit of details on his personal situation. So he says both he and his wife are 45 years of age and they've got 2 teenagers at home. Combined family income of about 850,000, so really decent family income there. It mentions they own a home worth about 1.8 mil, 3 investment properties worth 1 mil, 1.3 mil, and 1.6 mil, and all of their properties are in Sydney. They plan to retire at 60, so in 15 years. He mentions by very conservative estimates, by that time they'll have combined super of 3 mil, an ETF portfolio outside super of 3 mil, the home paid off, and all 3 investment properties well and truly positively geared but not fully paid off. He says we're hoping to leave properties to the kids to fund our retirements from super and ETF portfolio. He says we live a simple life but hope to spend some extra money in overseas travel and whatnot once they reach retirement. So his first question is, how does tax work in retirement when you're drawing an income from super and investments? E.g., they're intending to draw about 4% of their super balance, which is, that's the starting minimum pension withdrawal amount that you have to do anyway when you're 60, and then it tiers up. It goes to 5% at 65, I think, and then goes up and up and up as you get older. So that's about 120,000. And if the ETF portfolio gives you another 100,000 of income, does that get taxed at the bracket above 120,000, or is only that income considered for tax purposes? Right. So I get the question. So yeah, super is tax-free income. Super pensions are tax-free, Brenton. So that does not go towards your assessable income, your super pension. It's completely tax-free. So all that your income, your assessable income that gets taxed would be is the income from your ETF portfolio. If your investment properties are positively geared, so it's that positive gear amount goes towards your assessable income. And then if you're then drawing, obviously if you sell some of the ETF portfolio and there's capital gains there, that after the 50% discount, that goes towards your assessable income as well. So assuming you have no other forms of income or passive income or investments in personal name, that is really what your assessable income will be. It'll be from the share portfolio and from your property portfolio, but not from super. That's tax-free. Brenton's follow-up question then is, so in this sort of situation, is it better to spend all of your super first, then move into your investments rather than drawing down on both? No, I'd argue the other way around. With the sums that you're talking about, Brenton, it makes more sense to draw down upon the ETF portfolio in your personal name because that's creating taxable income, and whereas your super is tax-free invested, tax-free income. So it makes sense from a tax perspective to retain as much as you can in super, and if you're going to draw down upon capital, drawing down upon the ETF portfolio. And then in terms of your plans about, gifting the properties then as part of the inheritance to the kids, and then you just living off your super funds and the share portfolio. You haven't sort of outlined exactly how much you want to spend in retirement, but you mentioned that you're pretty conservative spenders, and I'd think off that balance there. You've got 6 mil combined across super and share portfolio in personal name. That's going to be, your plan's going to work fine there. I'm sure that you're not going to need to sell those investment properties, particularly if they're neutral or positively geared. So I think that that's certainly going to be enough for you to live off the super and the share portfolio. So I agree that you're in a really great position, by the way. I think you're in a fantastic position. So well done. And I think your retirement plan's certainly going to work when we're talking about these sorts of numbers. It just depends how much you want to spend, but I think it's looking quite strong. Brenton makes one final comment, which is, close to retirement, we might consider moving some of the money into super to maximize the balance within the transfer balance cap. Yes, certainly. I'd agree with that, Brenton. We do that quite a lot. I think once you're getting a bit close towards retirement and you're getting pretty close to the window in which the money in super is going to be invested tax-free and the income's going to be tax-free, it just makes sense to, shift some of that money. We do quite a bit of that, I think, in our plans. And when we meet with clients, it's looking at, okay, you've built up substantial assets outside of super and there's still some room within super that'll be tax-free. So it just makes sense from a tax perspective to shift where possible some of that into super. You just got to consider obviously the capital gains tax implications in, selling the investments, because moving it into super, obviously it's a change of beneficial ownership. So there's going to be some capital gains to pay when you sell some of those shares or whatever it is to then move it inside super. But I certainly think it makes sense. And I like that idea, particularly with the financial position that you're in. Certainly I'd think maximizing the transfer balance cap that you can have in super would make sense for you. So I agree. The next question now is from Nick. So Nick is married. He's 37 years old, so is his wife. They have 2 young kids. They live in their home, which is now fully offset, so they're fully paid off the home. And he mentions, the money in offset serves as a bit of an emergency fund, which is a great idea. I like that approach. He mentions about 3 years ago, they accessed some equity in their home to buy an investment property in Brisbane, which has gone up in value quite significantly. He's done quite well, he mentions. So, yep, well done. It's hard not to have done well, I guess, in Brisbane, but you've timed that perfectly. It's done really well there, Brisbane. And then he mentions also borrowed some equity to invest in around 120,000 into shares. He says that from that, he recently allocated about 40,000. So I'm guessing this is just a recent allotment or investment of, 40,000 of the overall 120,000. So he invested recently in some Vanguard shares. So he put 35% into VAS, which is the Vanguard Australian Share Fund, VGS, 55% into that. So VGS is the Vanguard Global Fund, and then VAE, which is a Vanguard Asia excluding Japan, but it's kind of like a broad-based Asia ETF there. And that was 10%. So he's gone 35% Aussie, 55% global, and then 10% in Asia. He mentions that over time he's invested another 100,000 into the same ETFs, but just from savings, not from borrowed funds. He mentions that Stuart has commented a few times that, we're not the biggest fans of VAS, so the Vanguard Australian Share Fund at the moment, but he says, look, that's just where I started and I've just kept at it. So that's the sort of simple and consistent approach that I've taken. But he's keen to hear our thoughts on that ETF mix, particularly from the perspective of long-term simplicity and diversification. And so he's got a bit of a decision here. He's got about 80,000 of that investment loan available to contribute, like facility left, about 80,000 that he can use. And he keeps circling back to that question is, the big question, is it property or shares? And he mentions he's quite comfortable with the ETFs at this point, the share portfolio, but he's got that nagging feeling, as he puts it, that he's missing out on the leverage the property offers. And so he's a bit stuck and he's at a bit of a crossroad. So in terms of the makeup of those ETFs, that portfolio, sort of simple portfolio that you've constructed for yourself there, look, traditionally, you see a lot of diversified portfolios in Australia and they tend to have kind of what you've got, like, you've got about 35% going into the Australian share market. Some have about 50%, so kind of 40 to 50% into the Australian share market is what most Australian diversified investments have. And then, the remainder is into the international share market. I'm going to be doing some analysis at the moment. I'm going to be writing a blog about, is that really what we should be doing? Just because we're Australian, should we be investing half of our share portfolio in the Australian share market, particularly when the Australian share market makes up less than 2% of the global market? And so I'm kind of really in that blog and podcast, I'm going to be breaking down, well, what are the benefits? Of course, there's franking credits, there's no currency risk, you're not needing to hedge, sorts of things. So there are some benefits, but I really wanted to sort of drill down into, are those benefits enough to really weigh up putting half of your portfolio in 2% of the market in Australia when there's also potentially better opportunities for investment abroad? So that's something I'm going to be diving into soon, Nick. But in terms of then the, using just Vanguard, so they're called, traditional indexes. Their technical names, market cap weighted indexes. So yeah, we've spoken quite a bit, Stuart has recently, about we're not crash hot on market cap weighted indexes at the moment, particularly if we look at Australia, so Australian market and the US market. And the reason being is just they're really top heavy. So you've got some large cap stocks, and it's more pronounced in the US with the Magnificent Seven, but it is also relevant in Australia with the banks and a couple of mining companies. But you've got a small number number of large cap stocks dominating the index, and those are what are driving the index and the market cap weighted, and those look overvalued. And so when you invest in a market cap weighted index, you're buying a large proportion of those stocks because they've become such a large percentage of the overall index, and they look overvalued, some of those to us. So that's why we have issues with it. I mean, look, long term, is this going to work? If you're doing your Vanguard, you're in market cap weighted indexes. Well, there's some theory out there and a lot of proponents that argue that market cap weighted index always is the way to go because, the big players end up taking a bigger portion of the market and then you get more of the winners, that sort of philosophy. But have we been investing in those things for our clients for the last year or two? No, not really. Not VAS or not VGS. We think under certain market conditions and certain layouts of the share market, I guess you could call it, perfectly fine. We have nothing in philosophy against market cap weighted indexes, but we just think under the current market conditions, because of that heavy weighting to the top end of the markets and the valuations perspective, we just don't think it's the right place to investing. So we've been branching out into other forms of indexing. So, still taking a low cost, passive, diversified approach to our portfolios, but we've been looking at other indexing ETF options, things like equal weighting, value indexing, quality, fundamental indexing. So there's a range of different other ways that you can, and also sort of particular segments of markets too. So we've been doing a lot more of that because we see better value and we see lower risk in those types of investments by accessing those different types of the indexes or markets. So we've been doing that, but perhaps, look, there's a lot in that, but maybe I could refer you to a couple of previous podcasts. So Stuart, well, even just last week in Stuart's Wealth First Principles, so the number 3 Wealth First Principles, Stuart talks about how to build a share portfolio. That one was focused on a share portfolio construction. So if you didn't hear that last week, that's a really good one. But there's sections in there where we're talking about, the different indexing methodologies. And then going further backwards, back in January last year, so almost 12 months ago, episode 340 is how to invest in the share market in 2025. In that, if you just Google Pro Solution and then that episode number or that episode name, you'll find it in there. There's some recommendations in there around some quality investment ETFs, some value investment ETFs, and a few other options in there that I've just mentioned of those different indexing methodologies. So I don't know, we'll complicate things a little bit. You're taking sort of, a fairly simple approach in just being Vanguard, split between Aussie and international, and that's okay. But perhaps there's other things that you could add to the portfolio that we think, well, we certainly would for our clients, that would complement the portfolio well and maybe show better value in the near term in terms of returns. And then to your other question about, should we do property? Should we continue sort of this leveraging into shares, using that borrowing capacity to go into shares, or should we go and leverage up further and go into an investment property? Really hard for me to answer, Nick. It really depends on, you're at a young age, you're at 37, so there's definitely capacity to, really sort of utilize your borrowing capacity. I think when you're 37 years old, you're in that real wealth accumulation phase. So it's not like, the last listener was kind of 50 and saying, should we go and buy an investment property? That's a different equation. So I really wouldn't have an issue with you gearing up and adding an investment property to your portfolio, but it really depends on your borrowing capacity. So I'm not sure what your income is, haven't mentioned it, but it really comes back to what's your income and therefore what's your borrowing capacity and therefore what's your surplus cash flow. So if you said to me, the income's combined family income's $500,000, we've got surplus cash flow of 100 grand or 150 grand per annum kind of thing, then I would think that, okay, sure, I think use some of the equity in the home, go and buy, a really good investment grade property, and I'd have confidence that A, you can get the borrowing to do that from the bank, and B, you're going to be able to service that and pay it down a little bit, not completely pay it all off over time, but pay off enough of that property that it gets to cash flow neutral and it takes care of itself and it then's just built into your portfolio. So really can't quite answer that one for you, Nick. I'm sorry, but it does depend on your personal circumstances, particularly around income and your surplus cash flow, which feeds into all your other expenses and living expenses and that sort of thing. So depends if you can and if it makes sense. And then finally, Nick just mentions that on the super front, that he's with Hester Super, and he's got about 170,000 in there, and his wife is with Aware Super with around 40,000. He says that he hasn't really paid a lot of attention to super until recently, but he wants to be a bit more proactive and be across it and be understanding what he's invested in. And he just wants to know our general thoughts on those funds and whether they're solid choices or worth reviewing. So look, without sort of getting, sort of specifically reviewing each individual products, one thing is I'll say, look, that's okay. I think an industry fund at your point is certainly for your wife. When you're at a lower balance, an industry fund is the way to go. At least I'd say below 100, 150,000, I think an industry fund is the way to go. The industry fund fees are really cost effective when there's a low balance because it's a small fixed dollar fee. but the percentage is okay. So then wherefore, if you've got a lower balance, then it works. It just makes sense from a fees perspective. Going into any other option, looking at a self-managed super fund or into a wrap super fund, it's not quite yet, I don't think. So it's fine to be broadly in an industry super fund, I think. We've spoken about quite a bit. Stuart does his, analysis, I think about every 6 months, where we look at our portfolios also, but then, all of the industry super funds, and we do a review of them all, and we kind of give our recommendation on what we think the best super fund is. And I'll refer you to episode 367, which is the best super funds for 2025, which Stuart released in July last year. So, there's a great data in there for you to go and review and assess options, because Stuart's pretty much mapped out a range of the top industry super funds, their different investment options, how they've compared across balance, growth, that sort of thing. And we have previously held the view that we think Uni Super is one of the best industry super funds, and it was right up there again. A range of different reasons there. Fees are good, performance is good, and they've got a much lower exposure to unlisted assets, which we think is going to be problematic for a lot of the industry super funds that are invested in some of these big, lumpy, unlisted assets. So, but we also threw in another option in there, which is a fairly new one, which is Vanguard Super Fund. So if you refer to that podcast and blog, you'll see we've given some numbers there, and Stuart's given some commentary around Vanguard Super, which is a relatively new player on the market, but it's a really low cost arrangement, the Vanguard Super, and it's pretty much a competition or another option to, an industry super fund for people with fairly low super balances, like in your situation. And I think it's a great option. You'd kind of then be having your personal investments, shares, and then your super fund in all Vanguard products. But in terms of the super fund product itself, I think it's a really good one. I think it's good for low balances as a starting point. So worth considering that, if not maybe Uni Super. And then you haven't even quite mentioned then what the investment option is. So even if you're not going to move super funds, and if Hester you deem is okay, or Aware Super's okay, just making sure that the investment option that you're in makes sense. So this obviously is not personal advice, it's just general, but generally speaking, for a 37-year-old for their super fund, I think that you want to be pretty much high growth or all growth, in my opinion. You've got to be able to stomach it, and it depends on your personal risk tolerance, but I think for most people in their 30s, you'd want to be, just make sure that you're invested appropriately. You're not in like a, balanced or conservative investment option or anything. So I'd keep it broad-based, diversified, but good level of growth in the particular investment option that you were within. And then I'd maybe consider having a look at that blog that Stuart posted around all the different industry super funds, as well as Vanguard, the new player in the market. So I hope that's helpful, Nick. Okay, and I've probably got time for one last question now, and I'm going to choose this question from Vanessa. So Vanessa gives some great feedback on the podcast. Thanks for that, Vanessa. She says that she recently received her annual statement from Australian Super and noted that the return on the balanced option for the 25 financial year was 9.52%. And after listening online to the podcast, I'd learned that the benchmark return for that year, particularly for ETF-based investments, was around 12%. I'm yet to reach out to Australian Super to better understand how the super is invested and why the poor performance. But she says, with that in mind, I'd appreciate your perspective on whether it might be worth rolling over my super to a potentially better performing fund, such as another industry super fund, Vanguard Super, StockSpot Super, or other. And she'd like our insights on just the general pros and cons of transferring superannuation to another fund and the key factors to consider before making a move. So Vanessa, I'm going to refer you again, just for a bit of useful information, to the same podcast that I just referred Nick to. So episode 367, or the blog on the podcast called The Best Super Fund in 2025, which Stuart released in July after all of the 25 financial year data became available from all of the industry super funds and Vanguard Super. So in that blog, we've pretty much mapped out, for balanced investment options and growth investment options across 10 top industry super funds, but then also including Vanguard. We've mapped out all of the performance of those, not only over the last year, but over the last 3, 5, 7, 10 years. It also includes the fees applicable within those investment options within all those different funds. So that'll be a really useful piece of material for you, I'd think. So I'd refer you to that. And as I just mentioned in the last question that I answered, in terms of industry super funds, we've held the belief, and we still do, that we think Uni Super is a really great industry super fund. If that's, an industry super fund is the best option for you. We also quite like Vanguard Super, which you've mentioned here, and we cover in that blog as well. I think that that's a really good alternative option, very low cost. Using their system, it's really user friendly, and I think that's a really good option, the Vanguard Super. And particularly their fees as your balance grows, really competitive and become more competitive than industry super funds. And you'll see in that blog there, Vanessa, you were talking about Australian Super Balanced is what you're in. So yeah, the 9.52%, we've got that in the data as well. You'll see in the 10 industry funds and Vanguard that we've covered that's at the bottom, the balanced option, 9.52. Basically, the 1-year returns go upwards from there across Rest, Hester, CBUS, UniSuper, Host Plus, and then up to Vanguard, which is actually the best performing one over the last 12 months in their sort of balanced option. So the performance of Australian Super wasn't great. Look, longer term, it's not too bad. It's all pretty close marginal numbers across a lot of the industry super funds long term. But, I'm not going to sort of give you the recommendation, but I'm going to give you the information to go and have a look at that and make your choice from a performance perspective. So then in terms of the pros and cons of transferring super, well, obviously there's the one where you might make the wrong call. It might be, who knows, like Australian Super could turn around and start performing better. You might go to the one of a fund that, has had a good historical performance, but it doesn't perform well going forward. So there's always that risk. But little things around, you need to be careful with insurance cover. So if you've got any personal insurance cover inside super, when you go moving super fund, it will cancel that insurance cover. You will probably get new default cover given to you. Most industry super funds do with the new super fund that you choose to go to, but you just need to be wary of that. Vanguard have their sort of default insurance cover through super as well, like industry super funds do. But you just need to be careful of that just in case you've got like more than average or more than default insurance cover. You just need to be careful of the fact that it will get cancelled, but you will likely get the default given to you on the new fund. But you just need to have a look at that. Look, there's a little bit of time out of the market. It's not a big one here. I'm not going to touch on it too much, but in the process, it could take, a week or 2 or 3 before, because they're going to have to sell down investments from your current fund, transfer over, do a rollover. And in that period of time, there is a little bit of time out of the market there. So it's a bit of, market risk. It can work in your favor, but also work against you in terms of what the timing of which you're out of the market. But these are pretty minimal things, really, if I'm honest. I mean, there's not too many cons of changing super, particularly if you're an industry super fund. So the big thing we look at in whenever you go changing investments is capital gains tax, but there is no capital gains tax that you'll pay upon moving out of Australian super. And this is pretty much the key point here is you notice that you won't pay any capital gains tax when you move super from an industry super fund. That's because it's inbuilt into the unit price and you're effectively paying capital gains on unrealized capital gains on an ongoing basis because it's built into the unit price. Whereas with other investments where you actually can accrue unrealized capital gains, well, you're not paying realized capital gains on an ongoing basis, not until you make changes. So there's no tax implications of moving. It's pretty easy, to be honest. I mean, setting up a new super fund with an industry super fund or Vanguard, pretty simple online application. They make the switch pretty easy. You just tell them the details of your old super fund, they'll move it across. But really, there's not too many cons with it, I wouldn't think. You've just got to make the right decisions about, also your investment option that you're going into. So if you're going to stay in a balanced option, then there's not too much of a change. You're staying at the same sort of risk profile. But those are some of the things I'd just consider. And just on that risk profile point there, you've mentioned here that you're 55 and, hope to reduce down to 3 days a week in 5 years when you're 60. But although you're very open to continue working full time and you're probably going to continue working longer than 60, just I assume because you want to. So really my point there is just about time frame. Whenever I think about the investment options that people should be in and the risk profile that you take, I think it's mostly dictated by time frame. Of course, we, internally when we're working with clients, we've got to consider their personal risk tolerance, but I think a lot of it should be dictated by how much risk you need to take, what's the risk return sort of trade-off, and time frame. So I think you kind of, you're in a balanced option. That's okay. That'll be fine. But you still got a fair while to be invested. I mean, if you're going to continue working, probably not going to access super till 65 then. So, that's 10 years that you've got to be invested. So balanced is okay if that's what you're comfortable with, but arguably a lot more people would be invested in more growth or high growth at that point in time. There's a lot of years there to recover from a down market. But, I think when people are getting within 3 or 5 years, maybe even 5 years, but maybe 3 to 5 years of retirement and accessing and drawing upon super, then that's maybe where you think about pulling back the risk profile, perhaps, of the super fund. But I think it's okay if you're in balance, but I just thought I'd mention that point. Okay, I'm going to leave it there for today. That's all the time I have. Until next time, bye for now.
Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.